If you hit buy on silver this morning because a headline made it feel safe, I've got some uncomfortable news. You weren't early. You're the exit. The door didn't open for you. It opened through you. Because yesterday, the entire financial feed went into hype mode. One of the biggest names on Wall Street dropped a shiny new research note saying silver could run to a specific number, high. Enough to light up every group chat, every FinTweet thread, every must-watch newsletter. And the story spread exactly the way these stories always spread. Fast, confident, and everywhere at once. It was on X. It was in market blogs. It was in your inbox. When a trade becomes that popular, the market doesn't reward the crowd. It uses the crowd. That headline wasn't a green light. It was a neon sign that said, "Liquidity available here." So when silver ripped up into the obvious zone, right where everyone expected the breakout party, big money didn't chase it. They sold into it. And the moment enough late buyers piled in, the floor dropped out like a trap door. Not because silver is crazy. Not because the world suddenly changed in 10 minutes. But because the game behind the chart did what it always does. It found the most crowded door and slammed it shut. Stay with me, because in the next few minutes, I'm going to show you exactly how that trap is built, step by step. So the next time the headline starts screaming, you'll see the ambush forming before it snaps.
What just happened at 83 wasn't random volatility. It wasn't silver suddenly getting moody like weather. It was a familiar market operation, clean,
repeatable, and designed to do one thing: harvest liquidity. You saw the run-up. Everyone saw it. Price got hot heading into a widely anticipated moment. The story got louder by the hour, and the crowd did what crowds always do. They crowded. Longs stacked on longs. Breakout buyers waited for the all-clear candle. Late entries chased the confirmation because the chart looked like it was giving permission. Then the headline hit, whatever version of good news you want to attach to it, and the market slammed the door in the
exact window where most people expect the celebration. That's the tell. News didn't cause the dump. News gave the dump a costume.
It turned a liquidity event into a narrative event so it would look normal on replay. Look at the mechanics. When silver tagged the high area around $83, that level wasn't just a number on a screen. It was a magnet for orders. Stops were clustered below. Buy stops were layered above. Leverage was highest near the top because confidence is always highest near the top. That's why those zones matter. Not because they're mystical, but because they're crowded. And when a level is crowded, it becomes usable. Big players don't need to predict the future. They need an exit. They need counterparties. They need size. The only place you consistently get that is where the public is most emotionally committed, right where the chart looks obvious. So the script frames $83 as a distribution shelf, the place where late buyers show up with urgency and market orders, and where institutions can sell into that urgency without blowing themselves up on slippage. Then comes the second step, the snap. The reversal isn't gentle because it's not meant to be gentle. It's meant to force decisions. A sharp dump does more than move price. It triggers stop-loss cascades, margin calls, and panic exits. It turns all hold-through noise into "I need out right now." That's how a trap closes. And the speed is the evidence. Slow sell-offs can be debated. Fast reversals are confessions. They reveal that the move was less about price discovery and more about positioning being cleared, fast. This is why the script treats the chart like a crime scene. Print is the fingerprint. The wick is the weapon. The timing is the alibi that doesn't hold up. Instead of telling you silver is volatile, it tells you to ask better questions. Who needed exits up there? Where was liquidity pooled? What did the crowd expect to happen, and how could that expectation be used against them? Because the market you're watching isn't a neutral scoreboard. It's a hunting ground for crowded bets. If you only react to headlines, you arrive last, after the exits are filled and the trap has already snapped shut. But if you track the setup, levels, crowding, timing, you start seeing the ambush forming before it triggers. And that's the real upgrade. Not predicting the next candle, but recognizing when the game is being played. So if $83 was the crime scene, the next question is the one most people never ask. Who built the trap? And what did they need from you to spring it? Because once you accept that the headline was just a costume, you're forced to see the real order of operations. It's not story first, price second. It's liquidity first, story second.
The market doesn't move to be fair. It moves to clear inventory.
And inventory only clears when somebody on the other side is willing to take the trade at size right when you least want to.
Here's the mechanism, clean and brutal. Step 1, invite participation. You push price into a zone that feels like a celebration. Breakout levels.
Round numbers, the area where every chart watcher is thinking the same thought. Finally, it's happening. That's where confirmation buyers show up. And retail traders, by habit, don't buy when it's quiet. They buy when it's loud. They buy after the candle proves it. They buy when social feeds turn into a victory parade. That's not a character flaw. It's a feature of human wiring. We mistake momentum for safety. Step 2, reverse hard. Not a polite pullback, a snap. Because the point isn't merely to move price down, it's to force action.
A violent reversal turns confidence into reflex. Stops clustered under the breakout get hit. Leverage starts choking. Margin calls spread like a chain reaction. People who swore they were long-term become right now sellers. And here's the part that should bother you. None of that requires a sophisticated reason.
Once the pressure points are loaded, order flow stacked, stops obvious, leverage elevated, the market doesn't need a story to move.
It needs a trigger.
A headline is perfect because it gives the move a narrative wrapper and keeps the crowd arguing about why, while the machine quietly does what positioning demanded anyway. This is what exit liquidity really means. It's not an insult, it's a description. When the crowd is euphoric at the top, their optimism becomes the fuel for professional distribution. Pros don't chase confirmation, they sell into it, because confirmation is where the orders are. It's where you can unload size without advertising it.
And when the unloading is done, the trap closes, fast, because speed is how you prevent the other side from calmly adapting.
So the practical takeaway isn't don't trade breakouts. It's sharper than that. Stop treating a vertical move as proof of safety. Ask a colder question. Where is the biggest group going to be forced to act? That forced action zone, especially around round numbers and widely hyped targets, is where traps become possible. And once you start tracking forced behavior instead of headlines, you don't just see the move, you see the setup. And once you understand the trap mechanism, liquidity first, story second, the next layer almost writes itself. Why did it have to happen there? Why not $81? Why not $85? Why did the market choose the $83 zone like it was a scheduled appointment? Here's the uncomfortable answer. Price levels aren't magic, they're memory. And 83 wasn't just a number, it was a place the market had already argued about, a place where somebody left unfinished business, and a place where the crowd would predictably behave the same way again. Charts don't have spells, they have receipts. Every major level is a folder of old decisions.
Who bought too late, who sold too early, who got trapped, who still has pain, and who is waiting for a second chance to get out at break even.
That's what a memory zone is. When price first prints a high near an obvious milestone, it doesn't just create a top, it creates a population, a group of participants anchored to that price. Some of them are winners who swear they'll buy the next dip. Some are losers who swear they'll sell if they ever get their money back. And some are professionals who now know exactly where the public will cluster orders the next time price returns. That's why $83 matters. It lines up with an obvious high, a crowded expectation, and a psychological milestone. It's the kind of place where sellers can hide in plain sight because everyone's eyes are already locked on it.
When price revisits a hot zone like that, the market isn't remembering in a mystical way. It's testing.
It's asking a very specific question. Is the demand here real, or is it just FOMO wearing a confident face? Real demand behaves differently.
It absorbs selling without collapsing. It holds levels without needing constant hype. It shows up when the tape is boring, not only when it's screaming.
FOMO demand is loud but fragile. It needs confirmation. It needs momentum. It needs the crowd. And when the $83 dump hit, the script reads it as the market answering the question. Demand was loud, but it didn't have a spine. This is where most traders get tricked by single candle thinking. One vertical run feels like a new era. One breakout candle feels like a regime shift. But a candle is not a regime. A candle is a moment. If the market can't hold the level, especially on a weekly close, then that move was a probe, not a takeover. The weekly close is the courtroom verdict. Intraday action is argument. So the warning is simple. Don't worship levels as thin lines on a chart. Treat them as decision area, zones where the next move reveals who actually controls the tape. And now you have a clean framework for $83. If silver reclaims that zone and holds it, meaning it doesn't just tag it, but lives above it, the trap thesis weakens. It suggests sellers ran their play, but demand absorbed the damage and came back for the shelf.
But if price returns and rejects again, that's not bad luck. That's the memory zone doing what memory zones do, confirming that sellers are still using $83 as a distribution shelf and that the crowd is still walking into the same room with the same expectations.
So now you know why $83 matters, and you know what a memory zone is really doing. It's not predicting the future, it's exposing who's trapped and who's in control.
But here's where most people still lose the plot. They stop at diagnosis. They stay mad. They keep replaying the candle like it's a personal betrayal.
And that's exactly where the market wants you. Emotional, narrative locked, arguing about why. The smarter move, the move the script makes on their purpose, is to pivot from outrage to a plan. Because once you've identified the trap, the only question that matters is simple and ruthless. What's the next confirmation? And how do you read it without guessing? Start with the next 48 hours.
Because that's where the market either tightens the noose or shows its hand. Right after a dump like this, price has to interact with support.
And support isn't important because it isn't a line on your chart. It's important because it's where the next forced decision happens. Watch how price behaves as it approaches those obvious levels. Does it slice through like there's no bid, clean, fast, no hesitation? That's panic and forced liquidation. That's the market telling you the move isn't done yet, because selling is not voluntary, it's structural. In that scenario, dips don't bounce the way your brain wants them to bounce because the sellers aren't evaluating value, they're closing risk. And when risk is closing, it doesn't negotiate. But if price hits support and starts to stabilize, if it turns into a grind, a sticky tape, a series of smaller candles that refuse to collapse, that's a different message. That's absorption. That's the market quietly finding a buyer big enough to take the other side without needing a headline. And here's the curious part. Absorption often looks boring. It looks messy. It looks like nothing is happening. Retail hates that. Pros love it because accumulation doesn't need to be loud. It needs to be effective. This is where you stop treating volatility as scary and start treating it as information. Fast, clean moves, sharp drops, straight lines, little retracement often signal forced activity. Stops, margin, liquidation. Choppy, overlapping action, price that refuses to trend cleanly can be the footprint of larger players' working size, not chasing it. The market is basically telling you whether the move is being pushed or being processed. Pushed moves are violent. Processed moves are sticky. Now zoom out to the weekly close, because that's the real verdict. Intraday action can lie. It can spike. It can fake.
It can run your stop in reverse before lunch. The weekly close is harder to fake because it's the settlement of narrative versus structure.
It answers, did the market actually accept higher prices or did it reject them? Did buyers defend levels when they had time to think? Or did they disappear once the adrenaline wore off? That's why a reclaim isn't a one-candle event. A reclaim is a behavioral event.
Price gets back above a key zone, holds it, and refuses to give it back.
A fail is also behavioral.
Price taps the zone, sellers appear instantly, and the market closes weak. So the roadmap isn't a prediction, it's a checklist.
Key levels. Where was the trap? Where is support? Where is the reclaim line? Momentum behavior. Is selling accelerating or tiring?
Reclaim/fail patterns. Does price regain $83 memory territory or get slapped away again? Reaction to obvious support. Does it break like glass or hold like concrete?
And the mindset shift is the whole point. Think like a risk manager. You don't need to call the exact bottom. You need to recognize which scenario is unfolding. Continuation, liquidation, or absorption reversal. Now here's the twist that makes that whole 48-hour checklist even more important. Silver doesn't behave like gold, so if you use gold instincts on silver,
You'll size the trade like an adult and get hit like a teenager. That's the analogy the script leans on for a reason.
it's not cute, it's operational. Gold is the parent in the room. Deeper liquidity, broader participation, a heavier, steadier footprint. Silver is the teenager, reactive, whippy, emotional on the tape, and unusually sensitive to who's leaning where. Same family, completely different temperament.
Silver can overshoot in both directions because it's thinner and more crowded, When it runs fast. The chart looks like it's telling you a story of inevitability.
And that's exactly when leverage arrives. Not because people are stupid, because momentum feels like proof.
The moment silver starts printing big green candles, the market attracts speculative positioning like a magnet.
That's the hidden fragility. Leverage is gasoline, and silver loves gasoline. It makes moves look powerful, right up until it turns into the Achilles heel on the reversal. Because when the tape snaps against a leveraged crowd, it doesn't unwind politely, it liquidates. That's why silver dumps feel like trapdoors opening beneath your feet. The selling isn't just selling, it's forced deleveraging. Gold usually doesn't play that same game at the same volume. Its liquidity base is different. Its participant mix is different. It can still trap people, absolutely, but it often does it with more adult pacing. A gold move can be cleaner, more stable, less prone to those sudden air pockets where price drops and your screen freezes for
a second, like it's buffering reality. Silver is more likely to do that because it's more easily pushed around at key moments, especially near obvious levels where stops and FOMO concentrate. That's why the $83 memory zone matters so much more in silver.
It's not just a level, it's a pressure chamber. And this is where traders quietly blow up. Not because their thesis was wrong, but because their sizing was wrong. If you treat silver like gold, you'll assume the market will give you time.
You'll assume pullbacks are orderly. You'll assume you can manage a position as it goes against you.
Silver punishes those assumptions. Silver moves can go farther than you think, faster than you think, and reverse harder than you think, because the structure is built on positioning sensitivity. When the crowd leans, silver tips. So the practical takeaway is simple and sharp. Risk in silver must respect speed.
Your plan needs wider error bars, faster invalidation, and a bigger appreciation for how quickly a normal pullback becomes a liquidation cascade. And that loops right back to the script's core message. You're not trading a metal, you're trading a game. One shaped by liquidity, leverage, and timing.
Silver just plays it louder. And once you accept that silver behaves like a teenager, fast, crowded, leverage sensitive, you're forced into an even more uncomfortable question.
If the tape can be pushed this hard in the short term, what exactly is the price you think you're watching?
Because the script keeps circling back to a bigger thesis that most traders only learn after they've been whipsawed a dozen times.
Spot price is not the whole story. It's the headline number on the dashboard. The real engine is underneath the hood. Derivatives, positioning,
Financing pressure, and the constant tug-of-war between paper claims and physical stress. This is why the $83 dump is framed as more than a spicy intraday event.
it's a window into the machinery. When price rockets into an obvious zone and snaps back on cue, that's not just sentiment changing. That's structure doing what structure does, clearing risk, resetting leverage, and rebalancing who holds exposure. Futures, options, swaps, call it whatever you want. Create a world where the majority of silver traded is actually claims on silver. Those claims can multiply quickly because they're cheap to create compared to moving real metal.
And that's the key. The system can absorb huge amounts of speculative demand without immediately touching
Physical supply. So yes, silver can be pushed around short term. In that world, price is often a function of positioning and liquidity, more than it is a function of bars leaving a vault. But that doesn't mean the long-term story is fake. It means you're operating with two clocks running at the same time. Clock one is the tape game. Daily moves driven by leverage, order flow, and forced positioning. Clock two is the structural arc. Demand narratives that don't turn off easily.
supply constraints that don't respond quickly, and inventories that can go from fine to a fragile M with startling speed.
The script is basically saying, if you only stare at clock one, you'll think nothing matters except the last candle.
If you only stare at clock two, you'll underestimate how violently the tape can punish you before the thesis plays out. That dual lens framework is where the viewer's mindset gets upgraded. A tactical trap doesn't invalidate a strategic thesis. In fact, sometimes it's the opposite. A dump can be the mechanism that cleans the system, shakes out weak hands, flushes leverage, and resets funding, and quietly sets up the next leg once the market is no longer top-heavy. That's why the script refuses to stay in outrage mode. Outrage keeps you trapped in the headline. The thesis wants you to separate signal from noise by asking two different questions on purpose. First, what is the market doing right now? That's structure. Reclaims, rejects, forced selling versus absorption, where liquidity is clustered, who's getting squeezed.
Second, what is the market becoming over time? That's fundamentals and constraints, how demand persists, how supply lags, how inventories behave when stress builds.
When you keep those clocks separate, you stop getting whiplashed by every headline costume. You stop confusing a liquidation event with a verdict on the metal, and you start reading the system the way it actually operates. Short-term games on top, long-term pressure underneath. Both real,
Both actionable and only dangerous when you mix them up. Once you're running the 2 clocks framework, structure today, fundamentals over time, the next move is almost insulting in its simplicity. You have to change what you do, not just what you believe.
because knowing the system exists doesn't protect you from it. The market doesn't reward awareness, it rewards behavior.
And this is where the script gets confrontational on purpose, like a coach who's tired of watching you repeat the same mistake. If you keep chasing candles, you will keep getting harvested. Not sometimes, not if you're unlucky. That's the design. The crowd chases the move.
The machine feeds on the crowd. Here's the role the viewer is being pushed into. Stop consuming the market like entertainment and start tracking it like a crime lab. Your job isn't to feel whether silver is bullish. Your job is to watch what price does at levels where people are forced to act. Because breakouts, especially the pretty obvious ones, aren't just opportunities. They're commitment zones. They're where the crowd overcommits.
That overcommitment creates vulnerability. Obvious stops stacked underneath, fresh leverage piled on top, and a giant neon. The script is trying to rewire you so you see a breakout not as a green light, but as a question.
Can the market actually hold this when the adrenaline fades? That's why touching a level is not the same as holding it.
Touching is easy. A single push can tag a number, print a screenshot, and bait an army of late entries. Holding is expensive. Holding means the market accepted the price and defended it through time, through volatility, and through attempts to break it. The difference is everything, and it's measurable. Reclaim versus reject. Weekly close versus intraday spike. Support behavior versus a clean slice through.
Those cues aren't sexy, but they're what keeps you from becoming the emotional fuel for someone else's exit.
The script also leans into a harsh truth. Markets teach participants by punishing poor behavior. Buy late because you want cohesion.
Place an obvious stop just below the obvious level. It wicks through, takes you out, and then reverses. Trust the headline? It uses the headline as a mask for a positioning reset. It feels personal because it's patterned, not because the market knows you, but because it knows crowds.
And crowds behave the same way at the same places over and over. So the mindset shift is the real takeaway.
Your job isn't to be right about the story. It's to be disciplined about entries, exits, and invalidation. You don't need a perfect prediction. You need rules that keep you from reacting like the crowd. Wait for proof. Demand acceptance, not hype. Track behavior at levels, not feelings about narratives. Because once you do that, you stop getting pulled into the candle chase, and you start operating on the side of the system that survives.
And here's where the script quietly does something most market breakdowns never do.
It doesn't just teach you how to read the flow trap. It shows you how to manufacture the message so you can ship it again and again without losing coherence.
Because if your goal is to stop chasing candles and start tracking behavior at levels, you need more than insight.
You need a production system that can turn a long narrative into a repeatable engine, scene by scene, without turning into chaos at minute 12.
Think about it. The same reason traders get harvested is the same reason creators burn out. Too much improvisation, too much ambiguity,
too many decisions made on the fly. The materials production philosophy solves that by treating video creation like manufacturing. You don't make a video, you build a pipeline. And the pipeline starts with standardization. Every scene follows the same schema, the same duration rhythm, often 8 seconds, and the same predictable fields. Scene number, setting, action, style, and when you need it, the exact voiceover text. That sounds boring until you realize what it unlocks: speed, consistency, and scale. Suddenly, a 15-30-minute story isn't a monster.
It's just 113 to 225 clean blocks you can generate, assemble, and revise without the project collapsing under its own weight.
This is the curiosity hook most people miss. The secret isn't better prompts. The secret is removing places where the machine, ambiguity is the enemy. If you leave gaps, the output drift. The host changes, the tone changes, the visuals become random, the retention dies.
So the system enforces constraints that act like guardrails. One main host identity if the format has a host.
We're seeing once unthinkable price ranges drift into plausible territory. Targets reshape perception and can create feedback loops independent of today's candle. No logos or watermarks, so you avoid distractions and compliance issues. And a clean separation between visuals and narration, so post-production stays sane.
Visuals are visuals, voiceover is voiceover, music is the spine. The real power is modularity. Once the skins,
A narrative stack forms. One layer for mechanics, one layer for story. Both influence the next move. Targets reshape perception.
want Vox/Cold Fusion motion graphics? Same structure, different visual grammar. Clean infographics, kinetic typography kept minimal, data icons, cinematic transitions. Want motion comic high impact? Same scenes, different aesthetic. Thick outlines, stamps, shock cuts. The narrative spine stays intact because the scene engine stays intact.
So the takeaway is ruthless and practical. If you want long-form videos that feel cohesive, like a case file,
Not a random slideshow, you don't rely on inspiration. You define the spec, enforce formatting, and make every scene a predictable unit of meaning.
one idea per scene, one beat per 8 seconds, one system you can run again tomorrow, next week, and next month without losing the voice, the pace, or the authority that makes viewers trust you. And once you've built the scene-by-scene engine,
You run into the part nobody brag about. But it's the part that decides whether your video feels like a professional market update
or like a glitchy AI experiment, quality control. Because here's the uncomfortable truth the workflow keeps hammering. Most projects don't fail because the ideas are weak. They fail because the execution drifts. A host changes faces halfway through. The voice pace jumps from calm to rushed. A scene breaks the schema and the whole batch becomes unusable. And the viewer, who doesn't care about your pipeline, just feels one thing: friction.
they click off. So the system treats QC like a risk desk treats exposure. Preventative, boring, mandatory.
First rule: one character, one identity, all the way through. If you're doing Studio Host plus charts, the host must be the same person. This is in every scene. Same look, same vibe, same framing, because consistency is trust. Your audience. Second rule: one voice profile and voice pacing aligned to a natural American read rate, roughly 160, 180 words per minute. That's not an aesthetic preference, it's retention math. If the voice runs too fast, comprehension collapses. Too slow, energy dies. The sweet spot keeps the viewer feeling like they're getting a crisp briefing, fast enough to feel urgent, calm enough to feel credible. Then comes the most underrated control: chunking. Splitting a 30-minute script into 130, 225 scenes is not copy-paste, it's surgery. You have to cut the script so meaning survives the cut. Each segment needs a complete thought, or at least a clean setup.
That naturally hands off to the next scene. If you slice mid-idea, the viewer feels the seam.
They don't know why it feels off, they just feel it. The workflow's answer is simple: one idea per scene, and every scene either lands a point or plants a question that the next scene answers. That's how you keep curiosity alive without the unsexy part that saves you hours: error-proof formatting. The deliverable discipline matters because your tool chain is unforgiving.
Output as pure JSON blocks with consistent keys. Keep separators clean. Make it exportable as a single TXT file so you can batch edit,
Batch generate, and batch fix without hunting through broken formatting. This is the equivalent of no typos in an options contract. One missing comma, one inconsistent field name, and your entire run can fail. Or worse, it rues but produces unpredictable drift. QC is how you prevent silent failure. And the production intent has to match the narrative intent. If your story is liquidity first,
story second, your visuals should behave like evidence. Charts, heat maps, order book snapshots, inventory style graphics, B-roll that proves the claim without clutter.
fast cuts, clean overlays, zero distractions. No tiny unreadable text. No random cinematic flourishes that feel like a trailer.
The vibe is update now, but controlled. High signal, no fluff. So the final takeaway is the same philosophy you applied to reading the market.
It's just that you don't rely on vibes, you rely on rules. Lock the spec, schema plus constraints.
Then enforce QC like it's non-negotiable. Do that, and you get long-form videos that feel cohesive, professional, and repeatable, where nothing drifts,
Nothing glitches, and the audience stays because every scene feels like the next piece of a case file they can't stop watching.